Welcome to the inventory quiz. In this session, you'll test your understanding of key inventory concepts. Each question is designed to reinforce your knowledge, and you'll have 15 seconds to respond to each one. Take a deep breath, get ready, and let's dive in. First question, and you're on the clock. What is inventory in accounting terms? Option A, assets held for sale in the normal course of business. Option B, cash on hand. Third option, long-term assets. And last option, prepaid expenses. You have 15 seconds. The clock is ticking. And the answer is option A. Inventory in accounting terms includes assets held for sale in the normal course of business, as well as assets in the process of production for sale, and assets in the form of materials or supplies to be consumed in the production process or in the provision of services. Great job if you got it right. Let's move on to the next question. Question number 2. A company uses FIFO for inventory valuation. During periods of rising prices, how does this affect the cost of goods sold (COGS) and net income compared to the LIFO method? Option A. Cost of goods sold will be higher and net income lower. Option B. Cost of goods sold will be lower, net income higher. Option 100. Cost of goods sold and net income remain the same. And lastly, option 500. Inventory value is unaffected by method choice. This is question 2, and you have 15 seconds. The clock is ticking. Best of luck. When a company uses the FIFO, or first in first out method, the oldest inventory costs are used to calculate the cost of goods sold, or COGS. So let's see how this plays out during periods of rising prices. If prices are increasing, the items purchased first, at lower costs, will be recorded as sold first. This means that the COGS will reflect these older, lower costs. And with a lower COGS, the net income for the company will be higher. To compare, if the company used LIFO, or last in first out, the most recent and higher priced inventory would be recorded as sold, resulting in a higher COGS and lower net income. So for our question, the correct answer is B. COGS will be lower, net income higher. Using FIFO in a rising price environment can increase reported profits. Just one reason companies carefully choose their inventory valuation methods. Let's look at how a company should handle obsolete inventory according to IFRS standards. Imagine this scenario. A company discovers it has inventory that's become obsolete. It can't be sold at its original cost, which brings up a critical question in accounting. What's the correct approach to account for this under IFRS? Here are the options. A. The inventory should be kept at its historical cost. B. The inventory should be written down to net realizable value. 100. No adjustments are required. 500. Inventory should be written up if future demand is expected. And the answer is option B. The inventory should be written down to net realizable value. Under IAS 2, inventories, inventory must be valued at the lower of its original cost, or net realizable value, known as NRV. NRV is the estimated selling price, minus any costs required to complete or sell the item. This ensures that inventory on the balance sheet reflects its true recoverable value, especially when items are obsolete and can't be sold at their original cost. By writing down obsolete inventory to NRV, the company complies with IAS 2, preventing overstatement of assets and presenting an accurate financial position.